Moneyweb now. On the money.
This podcast is brought to you by STANLIB Asset Management. Invest in more certainty to navigate volatile market conditions. Chatting with Warren Buhai, he is Senior Portfolio Manager, STANLIB Asset Management. Warren, appreciate the time. The first 6.5 months of the year, no shortage of market turbulence. Yet despite that, markets and even, frankly, the global economy have kind of been surprisingly resilient. What does your analyst tell us around what's driving that resilience in markets and global economies?
Thanks for having me on, Simon. I'd say firstly, obviously the oil price coming down. We know it sparked above $100 with the Iran conflict explosion.
Yeah.
Coming back to below $80 certainly helped. But more importantly, we think the AI, CapEx cycle going on is feeding massively into US growth and parts of Asian growth, as well as corporate earnings. We're seeing a very strong corporate earnings season both in Q1 and this one now that has just started in Q2. And a lot of that is driven by this AI CapEx in various parts of the world. And then thirdly, I would say fiscal support has been stronger than many people expected. So what I mean by that is fiscal deficits just aren't coming down. Central governments know they've got to support the market in uncertain times, and that's certainly what they have been doing. So I'd say those are the major reasons why the stability has remained despite, as you say, a lot of chaotic things going on at the moment.
You mentioned AI as an important support for markets, and AI is many things. It's the chip makers, it's the hyperscalers. More recently, it's been memory stocks. But is there sort of a risk of that market leadership, and it's becoming sort of narrower? Is AI still opportunity, or is it perhaps becoming a bit of a risk to the overall market?
Look, there's no doubt from our perspective that both the AI CapEx cycle that started in the last couple of years, still has a long way to go. Certainly all the companies' results we're seeing, if anything, it's been accelerating again the last couple of quarters. And as you know, the usage of AI has only really started rolling out over the last couple of years, and agentic AI has only really started rolling out this year. So it's reasonably early days, we would say, in the usage of AI. And so that's still got a long way to go, and that's clearly going to feed into parts of the market in terms of earnings growth and potentially productivity gains in the economy, which would be good. But for us, the risk is exactly as you say, that if leadership becomes too narrow, then the market, and disproportionate amount of returns come from the AI portion of the market, it does become worrying that the risk going forward is if anything changes with that AI theme, you kind of can get corrections. And there was a recent example now in Korea, actually in the last 3 weeks. The Korean market's come off 25% from its peaks because of those concerns maybe about the chip prices being too high for too long. So cycle definitely intact, but worryingly concentrated parts of the market can suffer big corrections over short periods.
Yeah, and in fact, a breaking story I just saw on Bloomberg that the Korean regulator says no more leveraged ETFs coming to market. That's been creating all sorts of complexities. You mentioned in AI early days, and it absolutely is. I mean, ChatGPT, not even yet 4 years old. We've seen a lot coming, but also I'm thinking, allied trades. Power is an important component there as well. I was chatting. We had the BHP. I mean, maybe we even got stories around copper. There is a space where it kind of, in a sense, broadens as well. We just don't know which way that market's going to swing.
Exactly. And that's exactly what we think the next part of the cycle is, hopefully in markets, is a broadening of the AI theme away from just what we call picks and shovels, which, as you say, are the chip manufacturers, and moving more out into the longer value chain of, say, that infrastructure build in power, where you need copper inputs, you need uranium, a lot of other commodities which have lagged, and you can have those becoming a lot more popular over the next couple of years as the cycle continues.
To change tack slightly, sticky inflation, how has that changed the role central banks can play in supporting markets?
Yeah, it's a great question because monetary policy for us is one of the bigger risks that we see at the moment. And what I mean by that is central banks don't have the same flexibility they had coming into this year. If you remember, coming into this year, us together with most market participants thought that we still could see interest rates declining, and they had been declining for a while. And then with the Iran war, you obviously saw that flip where the market expected a change from interest rate cuts to now interest rate hikes for the rest of this year into 2027. And that's become much trickier because inflation is quite sticky, not just driven by energy prices, but also, funnily enough, driven by what's happening with the AI CapEx build. As you mentioned, a lot of shortage in different parts of that market, feeding into that sticky inflation pressure. Labor markets are firm in the US, also leading to decent wage inflation. And generally growth, interestingly, we've seen more recent months a lot of the growth indicators we look at, things like manufacturing PMIs, have turned quite positive, and all this good growth is actually feeds into stickier inflation and makes the central bank ability to cut rates, which is ultimately always what they want to do, much tougher in this type of sticky inflation environment.
I hadn't thought of that. When growth is not bad news, it's always good news, but when growth adds challenges, I suppose. The last question, to your mind, what should investors be prioritizing at this point, sort of just after midway through the year?
I think for us, it's more the diversification, because markets have become so concentrated, as you mentioned. The range of possibility, the range of possible outcomes from us here have started to widen. In other words, in both directions, there's a very positive outlook you can think about if the AR boom continues, and you can think to the late 90s. If we kind of in the equivalent of 97, 98, there could be a lot more returns to come from the AR theme. But on the other side, sticky inflation, can feed into monetary policy getting tighter, and then you start worrying about bonds selling off, and does that eventually feed into equity? So the likely outcomes range is starting to widen. And therefore, it's important to be much more diversified, moving away from the concentrated parts of the market, like the pure AR theme and the picks and shovel winners that we've seen for the last 18 months. Try and get further exposure into what we would call the second and third order beneficiaries of AR, like I mentioned, down the commodity chain. And then kind of active asset allocation at the end of the day, which is, what we do as multi-asset investors. You've got to be active in this market, just because things like the example I gave of Korea can move so quickly. When big markets are moving 20 to 30% in a couple of weeks, you've got to move your feet when markets move.
No, they are. And I mean, double-digit overnight moves. I wake up every morning, I look at Korea, and I got no idea which way it's going to have gone, and it's going to go big. We'll leave it there. It's Warren Buhai. He is Senior Portfolio Manager, STANLIB Asset Management. Appreciate the time. This podcast is brought to you by STANLIB Asset Management. Invest in more certainty to navigate volatile market conditions.